For most people, financial collapse feels sudden. One day the system works, the next it doesn't. Banks freeze, markets seize, currencies weaken, and the explanation offered afterward is always simple: a crisis, a shock, a failure no one could have seen coming. But historically, collapse is never sudden. It is slow, methodical, and structurally logical. It begins long before panic, long before headlines, and long before anyone agrees there is a problem at all. What fails first is not money, or markets, or institutions. What fails is the underlying mechanism that once kept risk, reward, and reality in balance. Every major financial collapse, across empires, nations, and currencies, follows a remarkably consistent internal process. The names change, the instruments evolve, the technology improves, but the mechanics remain. This video is not about predicting the next crisis, assigning blame, or provoking fear. It's about understanding the hidden structure beneath every collapse, and why systems only appear stable right before they stop being so. Because once you see the mechanics clearly, the outcome is no longer surprising. The illusion of stability. Periods preceding financial collapse are rarely defined by visible stress. They are defined by apparent calm. Markets are stable, employment looks strong, corporate earnings are healthy, policymakers speak with confidence. On the surface, the system appears resilient, even successful. Historically, this is not a coincidence. Late-stage financial systems are designed to display stability, not reveal fragility. Volatility is suppressed through policy tools, risk is redistributed through complex instruments, and losses are postponed rather than resolved. The absence of immediate problems is mistaken for the absence of underlying risk. This is where surface indicators become misleading. Low default rates often reflect relaxed lending standards, not borrower strength. Rising asset prices signal expanding credit, not growing productivity. Strong growth numbers are frequently the result of financial acceleration, not economic improvement. Meanwhile, structural risk concentrates quietly. Debt moves off balance sheets. Leverage migrates into opaque corners of the system. Interconnections deepen without transparency. Each adjustment makes the system look smoother, while making it more brittle. This illusion of stability persists until a relatively small disruption exposes what has been building underneath, promoting a rapid shift from confidence to fragility almost overnight. Credit expansion as the true engine. Financial collapses are often described as shortages, a lack of liquidity, a sudden absence of money, a freezing of credit. But historically, collapse is not born from scarcity. It is born from excess. In every major breakdown, the expansion of credit accelerates far faster than the growth of real economic output. Debt multiplies not to fund productivity, but to sustain consumption, inflate asset prices, and preserve the appearance of stability. Credit becomes a substitute for income, and leverage replaces organic growth. This process is gradual and often celebrated. Easy credit lowers friction, boosts activity, and rewards participants in the short term. Businesses expand, governments spend, households borrow, and rising prices reinforce the belief that the system is healthy. But credit does not eliminate risk. It redistributes it across time. Each new layer of debt pulls future demand into the present while committing future income to repayment. Eventually, the system becomes dependent on continuous credit expansion just to maintain equilibrium. When debt growth can no longer outpace real output, the mechanism reverses. The same credit that once stabilized the system begins to destabilize it, turning abundance into fragility almost instantly. The time lag most people misread. One of the most misunderstood aspects of financial collapse is timing. Policy decisions rarely produce immediate consequences. Instead, their effects unfold slowly, often over years, creating a dangerous gap between cause and visible outcome. This delay generates false confidence. When aggressive monetary or fiscal measures are introduced, markets respond positively. Liquidity increases, growth appears to recover, and volatility declines. The absence of immediate negative feedback reinforces the belief that the intervention worked. But economic systems operate with long lags. Cheap credit today alters behavior gradually. It changes investment incentives, encourages risk-taking, and reshapes balance sheets over time. The damage does not appear as a shock, but as a slow distortion of capital allocation. By the time the consequences surface, the original policy choices are no longer in focus. New conditions are blamed instead: geopolitical events, external shocks, or market psychology. The underlying cause remains hidden in the past. This is where collapse becomes difficult to prevent. Once the lagged effects converge, reversing course requires removing support the system has grown dependent on. At that point, stability is no longer a natural state. It has to be actively maintained, often at increasing cost and diminishing effectiveness. Asset inflation versus economic health. Rising asset prices are frequently treated as evidence of economic strength. Expanding stock markets, surging real estate values, and growing paper wealth are interpreted as signs of prosperity. But historically, asset inflation and economic health are not the same thing. In late-stage financial cycles, capital flows increasingly toward assets rather than production. Credit is used to bid up existing financial instruments instead of funding new productive capacity. This creates the appearance of growth without expanding the underlying economy that supports it. As asset values rise, the benefits concentrate. Those who own assets see their wealth increase, while wage growth and productivity lag behind. Consumption is sustained through borrowing rather than income, further reinforcing the disconnect. The economy appears strong, but its foundation weakens. This decoupling is not immediately visible in headline data. Gross domestic product can grow while real investment stagnates. Markets can rally while industrial output slows. The financial system begins to operate according to its own internal logic, increasingly detached from real economic constraints. Eventually, asset prices reflect not value creation, but liquidity conditions. When those conditions change, prices adjust rapidly, revealing that what looked like prosperity was largely financial inflation, not durable economic strength. Leverage, the silent multiplier. Leverage rarely attracts attention during periods of stability. It operates quietly in the background, enhancing returns, smoothing volatility, and making modest gains appear sustainable. But leverage does not create value. It magnifies exposure. In highly leveraged systems, small disruptions carry disproportionate consequences. Minor price movements, temporary liquidity constraints, or localized defaults can cascade through interconnected balance sheets. What would have been a contained loss in a low-leverage environment becomes a systemic event. Regulation does not eliminate this dynamic. It redirects it. As oversight tightens in visible sectors, leverage migrates elsewhere, into shadow banking, derivatives, structured products, and off-balance sheet arrangements. Risk is not reduced, it is obscured. This migration creates a false sense of security. Official metrics show improved capitalization and reduced volatility, while leverage quietly accumulates where transparency is lowest. The system appears safer, precisely because its most fragile components are harder to observe. When stress finally emerges, it does not originate where regulators expect it. It surfaces in the least regulated segments and spreads rapidly through contractual obligations and liquidity channels. At that point, leverage stops enhancing stability and begins to enforce it, forcing rapid deleveraging, asset sales, and contagion across the system. Institutional incentives that guarantee failure. Financial systems do not drift toward collapse by accident. They are shaped by incentives that consistently favor short-term stability over long-term resilience. Banks, governments, and corporations operate within frameworks that reward immediate performance while diffusing responsibility for future consequences. For financial institutions, profits are measured quarterly, risk is often transferable, and losses can be socialized during crises. This encourages balance sheet expansion and risk-taking during favorable conditions, even when vulnerabilities are accumulating. The downside is delayed and often borne elsewhere. Governments face similar pressures. Political cycles reward visible growth, low unemployment, and stable markets. Policies that defer costs into the future are easier to implement than those that impose short-term restraint. Stability becomes a political objective, not a structural one. Corporations respond to capital markets that prioritize earnings, share prices, and financial engineering. Investment in productive capacity competes with leverage, buybacks, and cost optimization, strategies that improve near-term metrics while increasing fragility. Together, these incentives align behavior across the system. Each participant acts rationally within their own constraints, yet collectively increases systemic risk. Collapse emerges not from individual failure, but from incentive structures that make long-term instability the logical outcome of short-term success. Currency degradation as a policy choice. Currency degradation is often described as an unintended consequence of crisis management. Historically, it is more accurate to view it as a deliberate policy choice. When debt levels become unmanageable and defaults are politically or socially unacceptable, weakening the currency becomes the path of least resistance. By expanding the money supply, policymakers reduce the real burden of existing debt. Obligations remain nominally intact, but their purchasing power erodes over time. This allows systems to avoid visible defaults while effectively transferring losses across the economy. This process rarely feels dramatic at first. Inflation tends to appear unevenly, lifting asset prices before wages adjust. Savers lose purchasing power gradually, while debtors benefit from repayment in devalued currency. The redistribution occurs quietly, without formal restructuring or explicit acknowledgement. Currency degradation also buys time. It sustains liquidity, supports asset markets, and delays the recognition of insolvency. But it does not resolve structural imbalances. It shifts them forward and outward. As confidence weakens, the effectiveness of debasement diminishes. Each new intervention requires larger measures to achieve the same stabilizing effect. Eventually, the currency itself becomes a source of instability, transforming a tool of delay into a catalyst for the next phase of collapse. Confidence as the real currency. Modern financial systems are built on mathematics, models, and contracts, but they operate on something less tangible: confidence. Balance sheets can remain technically solvent long after trust begins to erode. Once confidence falters, even sound institutions become vulnerable. Money itself is a confidence instrument. Its value depends not on physical backing, but on collective belief in its acceptability and stability. The same is true for banks, markets, and governments. As long as participants trust the system to function tomorrow, it continues to function today. Collapse begins when that belief weakens. Liquidity dries up, not because assets disappear, but because counterparties hesitate. Credit markets freeze not due to insolvency, but uncertainty. Participants stop assuming obligations will be honored smoothly, and behavior shifts accordingly. This transition is subtle. Confidence does not vanish overnight. It decays through small breaks, unexpected policy changes, inconsistent messaging, or failed assurances. Each episode slightly alters expectations. Once trust crosses a critical threshold, the system changes state. Actions that once seemed irrational become rational responses to uncertainty. Withdrawals accelerate, markets reprice, and stability evaporates. At that point, mathematical solvency matters less than psychological reality, and restoring confidence becomes far harder than maintaining it. The containment myth. Modern financial systems are often described as more resilient because risk is distributed. Securitization, derivatives, and diversification are presented as tools that contain localized failures. In practice, they rarely eliminate risk. They repackage it by slicing, transferring, and dispersing exposure across institutions and markets. Financial engineering reduces the visibility of concentrated risk. Individual participants feel protected, assuming losses are absorbed elsewhere. But this sense of safety depends on the assumption that correlations remain low and liquidity remains available. In stressed environments, those assumptions break down. Instruments designed to diversify risk begin to move together. Hedging mechanisms rely on counterparties that are themselves under pressure. Liquidity evaporates precisely when it is needed most. The result is not containment, but synchronization. Losses emerge across sectors simultaneously, overwhelming systems built to handle isolated failures. What appears diversified on paper becomes tightly coupled in reality. This is why modern collapses tend to be broad rather than localized. Financial engineering smooths volatility during expansion, but links participants through complex obligations. When the system turns, those connections transmit stress rapidly. Risk is no longer concentrated in one place. It is embedded everywhere, making collapse harder to isolate and easier to spread. Why bailouts change the system itself? Bailouts are often framed as temporary measures, emergency responses designed to stabilize markets and restore normal function. In the moment, they frequently succeed. Immediate failures are contained, panic subsides, and continuity is preserved. But intervention does not simply pause the system, it changes it. When losses are absorbed externally, market behavior adapts. Participants learn that extreme downside can be mitigated through policy action, while upside remains private. This alters risk assessment, encouraging strategies that would be unacceptable in a system where failure carried full consequences. Over time, expectations harden. Markets begin to price in intervention as a feature, not an exception. Liquidity support, asset purchases, and guarantees become implicit assumptions rather than emergency tools. Stability becomes dependent on continued action. This dynamic increases fragility. Risk accumulates faster because constraints are perceived as softer. Capital flows toward leveraged structures that rely on support rather than resilience. The system grows larger, more interconnected, and more sensitive to policy shifts. Eventually, intervention faces diminishing returns. Each rescue requires greater scale to achieve the same effect. When credibility weakens or capacity is questioned, the very mechanisms designed to prevent collapse can accelerate it, not by failing outright, but by having reshaped behavior in ways that leave no room for error. Financial collapse is often followed by promises of reform. New rules are proposed, accountability is discussed, and structural change is widely expected. Yet historically, the aftermath follows a more consistent pattern. Crises concentrate power. As weaker participants fail or are absorbed, assets move toward those with access to capital, liquidity, and political leverage. Institutions deemed essential survive, often larger than before. Emergency measures favor scale and connectivity, accelerating consolidation rather than decentralization. This process is not necessarily orchestrated. It emerges from constraints. During collapse, speed matters more than ideal outcomes. Authorities stabilize what can be stabilized quickly, reinforcing existing centers of influence. Smaller entities lack the resilience or access required to endure prolonged stress. Capital follows the same logic. Distressed assets are acquired at reduced prices by those able to wait. Market share consolidates, competition diminishes, and economic power becomes more concentrated than before the crisis. The system that emerges is not reset, it is reshaped. Complexity increases, dependency deepens, and barriers to entry rise. While stability may return, it rests on a narrower foundation. The endgame of collapse is rarely renewal. It is a tighter, more centralized structure that carries forward the same vulnerabilities now embedded at a higher level. Most people approach financial collapse as a timing problem. They look for signals, countdowns, and decisive moments that announce the end. But collapse rarely reveals itself on a calendar. It unfolds through shifts in structure long before visible failure. The critical insight is not when a system breaks, but where risk is being moved. Financial systems under strain do not eliminate vulnerability. They relocate it, from balance sheets to currencies, from institutions to households, from explicit losses to hidden erosion of purchasing power. These transfers are subtle. They occur through policy choices, market design, and incentive structures that appear stabilizing on the surface. Risk becomes harder to see, not smaller. Stability is preserved by pushing fragility outward and forward in time. Understanding this changes how collapse is interpreted. It becomes less about prediction and more about observation, noticing which participants are protected, which are exposed, and which mechanisms absorb stress reveals more than any forecast. Historically, those who navigate collapse effectively are not those who act early out of fear, but those who understand how systems adapt under pressure. They recognize when stability is being manufactured, where the costs are landing, and how to position themselves as the system evolves, not after it finally breaks. Financial collapse is often framed as a failure of foresight, something that could have been avoided if the right warning had been heeded. In reality, collapse is usually the result of systems doing exactly what they were designed to do under pressure. The mechanics you've seen are not anomalies. They are recurring responses to excess, constraint, and incentive. Stability is extended, risk is relocated, and consequences are delayed, until delay itself becomes the risk. Understanding this is not about fear or prediction. It's about clarity, about recognizing when strength is being displayed rather than built, and when protection for the system comes at the expense of those within it. History suggests that financial systems don't collapse because people stop believing in them. They collapse because belief is used to postpone adjustment for too long. And once that becomes clear, the most important question is no longer what will happen, but how prepared you are to recognize the difference between stability that endures and stability that is merely maintained.